Everybody, what is happening? It's Bill with Franklin Loan Center, and I am gonna jump on a super slippery slope here, and I'm just seeing so much talk about all this stuff that we're expecting out of the administration, and what impact any of this stuff could have on interest rates, right? And so, one thing that's hovering out there, and look, I get it. I know some of this stuff for some people is really controversial, and I'm sure there's going to be fallout in ways we don't totally expect. Everything's nuanced, right? But like the whole Department of Government Efficiency thing, so let's just be clear. If the government finds $500 billion, which they're saying they think they can easily find, it sounds like they've already found huge chunks. If they can find a way to save $500 billion, which is obviously no small task, and our current deficit spending, well, the deficit spending last year was $2 trillion, right? So, by the way, it's really important to note, the way the Fed pays for a deficit like that is they issue treasuries, right? And they issue all different duration of treasuries, but one of those is the 10-year treasury, which runs pretty dang closely with mortgage rates, right? And then I also want you to remember the simple economics 101 of supply and demand, right? So, because mortgages are a bond, mortgage-backed securities are bonds, so that's what sets mortgage rates, right? And then you also have treasuries, and those are essentially in competition with each other, right? I mean, they're kind of a similar investment sort of profile, and so when you have when you have to sell an extra $500 billion in treasuries to pay for the deficit, then that's just going to drive interest rates up, right? So what do you do when something's more, when there's a bunch more supply of something? So you have a whole bunch of widgets that are going into the market that you need to sell, and to get those to sell, like when there's maybe not as many or the same amount of people that maybe want them, what are you going to do? You're going to have to drop that price to be able to get people to buy it. And remember, with bonds, the price runs inverse to the interest rate, right? So if you drop the price on a bond, it means the interest rates are going up. And so that's exactly the situation here, right? So if DOGE goes in and finds, I don't even know if I'm saying that right, by the way, but if DOGE goes in and finds, again, $500 billion, then that's $500 billion in bonds that don't have to get sold from the Treasury. And so that should theoretically, just based on supply and demand, allow for a higher price and allow for lower interest rates. And then that should bleed over to mortgages as well, right? So look, I mean, I can just say, generally speaking, look, you want to go in there and find a bunch of wasteful spending, please go do it. I also fully acknowledge that there will be some fallout. You take a chainsaw to something, you're definitely going to get the tree to fall down that you wanted to fall down, but you're probably going to take some other things with it. So look, there's a whole conversation around that, but I want you to be really clear. If they go find that level of wasteful spending and they fix that and don't replace it with other wasteful spending, then that could be good, and it frankly should be good for interest rates, and we should all be cheering for that in the real estate business. So anyway, I just wanted to kind of put that out there. I know it's complicated. I know it takes a bit of understanding of bonds and stuff like that. Hopefully this helps out, but I'm one that's definitely cheering for, guys, let's get some of this wasteful spending, and more importantly for me, get the supply of treasuries down for this coming year and hopefully going forward. That should bring mortgage rates down for us. So that would be good. All right, that's it. I'll see y'all next week.